The first assignment that we'll look at in Chapter 14 will be Exercise 14.2, and this one deals with merchandise inventory adjustments and the adjustments to customer refunds payable and sales returns and allowances. So we have a business called Sam's Stuff. He did a physical inventory and discovered that he has $72,000 at the end of the year in his regular inventory account. Then he estimates that $5,000 of sales from this year will be returned next year, and the cost of that merchandise that's going to be returned is $3,000. So now we have the information we need to adjust these accounts. To get started, the first thing we'll do is enter the balances from the trial balance. So merchandise inventory has $60,000. Then estimated returns inventory had $2,500, and customer refunds payable had $4,000, and then sales returns and allowances had $20,000. So now we can begin our adjustments. On A, it says remove the beginning balance in merchandise inventory. So if we look at our trial balance, we have $60,000 sitting in the debit position. Merchandise inventory has had that $60,000 balance since the beginning of last year. So this is our old balance. It's the incorrect one, and we need to remove it. So if it has a $60,000 debit, to get rid of it, we're going to credit it. So in merchandise inventory, we're going to credit the account for $60,000. And notice that just offsets this debit and takes merchandise inventory to 0. Now when we credit, we need an offsetting debit somewhere. So we're going to come down and enter that credit into income summary. The next step is to add the new balance per the physical account. So our count was $72,000 on December 31st. So we have a new balance that we're going to enter now. And to add a balance to merchandise inventory, we're going to debit it. And as our offsetting credit, we're going to come down and credit income summary. Okay, so we have removed the old balance and added the new balance in merchandise inventory. Okay, and that's going to give us an adjusted trial balance of $72,000. So this is our new balance in merchandise inventory. On C, it's asking to adjust the customer refunds balance to the new estimate of next year's return. It says to use one adjusting entry. So we are dealing here with the customer refunds receivable. So we need to come up and see what our balance actually is. So Sam estimates $5,000 to be returned in as customer refunds. So let's look and see what our balance is now. It's $4,000. So that means that we need to raise this $4,000 up to $5,000 to meet the estimate that Sam has for this year. Okay, so we have a credit of 4. To make that go to a 5,000 credit, we need to credit customer refunds payable for $1,000. So we'll come down to customer refunds payable, and for C, we'll add a credit of $1,000. Now our offsetting debit to this is going to be our sales returns and allowances account. So we've started with 20, and we're going to add another 1,000 because we're anticipating that figure to actually rise as customers return goods from this year next year. So our adjusted trial balance in this account will be 21,000, and then in customer refunds payable, our adjusted trial balance will be 5,000. In D, it says remove the beginning balance in estimated returns inventory, and then in the next step we'll add the new balance. So this is the returns that we're anticipating at cost. So it says the cost of the expected merchandise to be returned is $3,000. So we have the estimated returns inventory now at $2,500. So we're going to, since it's another inventory account, we're going to use that two-step process again. We're going to remove the old number, to bring this account to 0, and then we're going to run that offsetting debit through income summary. Okay, so we've removed the old number, and remember the new number is 3,000, so we will debit estimated returns inventory for 3,000, and then run the offsetting credit through income summary. Okay, and our adjusted trial balance here in estimated returns is going to be 3,000 because we've offset the 2,500 debit with a credit, and the only thing remaining is the 3,000 estimated returns inventory. Okay, so that concludes that exercise. We'll move on. We'll go down to 4 now. In 4, we are going to calculate cost of goods sold, and in this one we're going to be using those two inventory accounts, the regular merchandise inventory and the ending merchandise inventory. So that's the small change that we have here to our cost of goods sold calculation. Okay, so we're given all our figures, and then the beginning and ending figures for the estimated returns inventory and the regular inventory. Okay, so with cost of goods sold, we always start out with beginning inventory. So merchandise inventory beginning is 27,000, and then the beginning estimated returns inventory is 2,000, which will give us a total here of 29,000. Next, we figure the purchases. So now we have what we started with. We need to add the purchases of what we've added to our inventory. So we just start with purchases, which were 78,000. And we're going to subtract purchase returns and allowances of 3,900, and then subtract purchase discounts, which were 6,000, and those total $9,900. So we have a $9,900 reduction in our purchases due to returns and discounts. So our net purchases will be $68,100. Now we have another account that affects the cost of our purchases, and that's our freight. So we're going to add our freight in, which was $350. So the cost of our purchases is going to be, let's see, $68,450. So now we can figure our goods available for sale because of what we started with plus what we purchased. And if we add those two figures together, we get $97,450. That's everything in our store that we could have sold to our customers. So now we're going to figure out what we still have. So if we know what we still have, we can figure out what we sold by subtracting it from our goods available for sale. So we need our ending inventory for merchandise inventory, which is $22,000. And we need our ending inventory from estimated returns. And our total ending inventory is $23,600. And so our cost of goods sold is then the $97,450 less the $23,600, which will give us $73,850 as our cost of goods sold. Okay, the next problem we'll look at is number 5. This is our unearned revenue adjusting entry. So we've got T accounts for all the accounts that we'll need for our unearned revenue. In A, it tells us that we sold $1,200 in season tickets at $400 each, and we received cash of $480,000. Okay, so first thing we need to do is record the sale of the unearned revenue. Okay, so we received cash, but we can't call it ticket revenue yet because we haven't earned it. We have not earned that revenue by performing a service yet. So we are going to credit unearned ticket revenue, which is a liability account, instead. If something happens and we can't perform the service, we are obligated to refund this money. So it is a liability until we earn it. Okay, in B, it says an end-of-period adjustment is needed to recognize that $120,000 in ticket revenue has been earned. So you're always trying to figure out how much you've earned to put into the ticket revenue. So it's telling us in this case that we've earned $120,000. So we're going to remove $120,000 from the unearned ticket revenue and actually take it into revenue in our ticket revenue account. Okay, so for this adjustment, read your passage carefully. This is telling you that you've earned $120, so that's the reason we put the $120 in the revenue account. Sometimes it'll tell you the ending balance in the unearned account. And if it does, you have to do some math. You would have to say 480 minus whatever remains to get your ticket revenue. So you have to read the passage carefully and ask yourself, how much did I earn? And that will be the amount of your adjustment. Okay, we'll move to 6. Okay, in this one we're looking at a partial worksheet. So it says here, this is a worksheet for Karen's gift shop. The ending merchandise inventory is $60,000, And Karen is estimating that customers will be granted $15,000 in refunds next year for merchandise sold this year, and the cost of those returns is $10,000. Okay, so we're going to complete our adjustments column and then extend those over to the trial balance. So this assignment is going to help you with your worksheet. It's going to show you how to extend your inventory accounts and then how also to extend your income summary account. Okay, so the ending inventory is 60, so I know that's my new figure. Right here in the trial balance is my old figure. So the first order of business is to get rid of this $55,000 debit with a $55,000 credit. Okay, and then we're going to come down and put that debit that offsets the credit in income summary. Okay, so we've gotten rid of the old number. Step 1. Step 2 is to enter the new number. So we're going to add $60,000 to our merchandise inventory, and then our offsetting credit is $60,000. Okay, now we'll work with, let's go ahead and do the estimated cost of the returned inventory. Okay, so we want to get rid of the old number that's been here since the beginning of last year. Okay, so a credit of $8,000 will zero out the debit of $8,000, and then we'll run the offsetting debit for the $8,000 in through income summary. And now we need to put the new figure in, which was $10,000. So we'll add $10,000 to our estimated returns with a debit, and then offset that debit with a credit to income summary. Okay, and then next we will adjust the estimated customer refunds payable. So the new figure she's estimating is $15,000. Right now we're sitting with a $12,000 credit. So I need to bring this $12,000 credit up to $15,000. So I need to credit for $3,000 more to bring the figure up to $15,000. Okay, and remember, this represents the refunds at retail. So our offsetting account for customer refunds payable, the debit is going to be sales returns and allowances. Okay, so now let's move these over. See if I can get my screen to move over. Here we go. Okay, so we need to complete our adjusted trial balance. So this is our merchandise inventory account. Okay, the $55,000 goes away. It's a $55,000 debit and a $55,000 credit. Bring the account to zero. The only thing I'm left with is a $60,000 debit. So that's the balance in my merchandise inventory account. For estimated returns, the $8,000 is offset, so that account was brought to zero, and the only balance remaining is our new balance of $10,000. Customer refunds payable had a credit of $12,000. We gave it another credit of $3,000, which brings our balance to a $15,000 credit. Okay, now we are at our income summary account. All right, this is a little different from what we've seen before. We're not netting out these figures, we're keeping them separate. So I'm just going to bring them over exactly the way they sit in the adjustments column. And the reason is this is going to help us to calculate our cost of goods sold, because I know that the first number in the account is the beginning balance, and the second number is the ending balance. So when I'm ready to prepare my cost of goods sold section, I can just go to the income summary account, and I have my two balances right there. Okay, we've got sales, which was not affected, so it was not adjusted. Let's see, sales returns and allowances was adjusted. It has a debit of $18,000, and then we're giving it another debit of $3,000. So a debit and a debit we add, and we get a debit of $21,000. Let me put that revenue figure in there. It had no change. It was just carried over as a credit. Okay, the next account is purchases, purchase returns, purchase discounts, and freight. None of those changed. So we're just going to bring those over the way they were. Okay, see if I've forgotten anything. Okay, it looks good. All right, now in the second portion of the problem, we're just going to calculate this cost of goods sold real quick. I'm going to try to move through it quickly. Remember, we start with beginning inventory, and that was $55,000. And we've also got the beginning inventory of the estimated returns. That was $8,000. And now we'll total that over to the right. That will give us $63,000. Then we start with purchases. So our purchase figure was $200,000, and all this is coming straight from the worksheet that was above. We had purchase returns and allowances. Oops, $3,000. Purchase discounts of $2,500 for a total reduction in our purchases of $5,500. So our net purchases are $194,500. Then we have the freight. The freight is always a cost of our inventory. It adds to it. So that was $1,400. So our cost of goods purchased comes out to $195,900. Now we can calculate our goods available for sale. Beginning inventory plus the cost of goods purchased is $258,900. And now we need to fill in the ending inventory so that we can figure out what we sold. So ending inventory for our merchandise, and just to run back up here, if we look at the income summary account, we know that that ending inventory is 60. At the beginning of the calculation, we entered the beginning inventory of 55, and our ending inventory now we're going to enter for regular inventory at 60, and then returns inventory at 10. It's the second number on the adjusted trial balance for income summary. Okay, so 60,000 and 10,000. So our ending balance total 70,000. If we had $258,900 to sell and we've only got $70,000 now, the difference is missing, so we're assuming it was sold. So that will give us a balance of $188,900. Okay. Next we'll look at exercise 9 that deals with the perpetual inventory system. So this is just a review of the perpetual journal entries when we purchase merchandise and when we sell it. So on June 1st, we purchased merchandise on account from Bridge Builders Material. So keep in mind, under perpetual inventory, the merchandise inventory account is an active account. So all our purchases go in merchandise inventory instead of the purchases account. Okay, and then that was purchased on account, so we'll credit accounts payable. Okay. On June 3rd, we purchased merchandise for cash. Okay, so pretty much the same entry. We're going to debit merchandise inventory and credit cash for $400,000. Then on June 5th, sold merchandise on account to Champa Construction. The sales price was $20,000 and the cost of the merchandise was $15,000. Okay, so the first thing we're going to do is enter the sale. So that's the same whether it's under the periodic or the perpetual system. Debit accounts receivable, credit sales at the sales price. Under the periodic method, this would be the only entry, but since we're using the perpetual method, we need to move this merchandise out of inventory into cost of goods sold because we don't have the inventory anymore. It was sold. So we'll increase cost of goods sold by $15,000 and then decrease our merchandise inventory by $15,000. So the merchandise inventory is very active. We increase it when we make purchases, and then we decrease it when we make sales. Okay, I guess let's check my work. All right, the last one we will look at is number 11. Yeah, this is the adjustment under the perpetual inventory system. So this is adjusting for inventory shrinkage. And shrinkage is just the change in inventory because of errors, breakage, theft, etc. So even though under the perpetual system our merchandise inventory is constantly being updated, there are going to be issues that cause the figures to be a little bit off. So periodically we have to go in and count the physical inventory under the perpetual system so that we can make sure that our books are where they should be. So it says Anup Enterprises completed a physical count. The merchandise inventory account shows a balance of $350,000, so that's what's on our books, and the physical count showed $325,000. So we are reporting $350,000, but we've only got $325,000. So we need to bring our book balance down to $325,000. So we're going to credit merchandise inventory to do that. And then we're going to debit inventory short and over.